Database provider MongoDB released earnings last night and shares are down as much as 6% following that release. So what does this mean for shareholders, and was it that bad of a report? My name is Brian Stoffel. We'll spend the next 10 minutes trying to figure that out. We'll also try and figure out if it's finally reached MongoDB evaluation that might make some consider investing in it. At the time of this recording, I do own shares of MongoDB and want to give a shout out to YCharts for sponsoring today's video. More from them in just a bit. So this was MongoDB's fiscal third quarter of 2024. Yes, they have a weird calendar. 2024, about a $30 billion company. Revenue grew 30%, well ahead of both Wall Street's and management's guidance on the top line, and on the bottom line, a lot to like. On a non-GAAP, mostly because of stock-based compensation, basis, the company more than tripled its earnings per share, pretty much quadrupled it to 96 cents. That was pretty much double what Wall Street and management had expected. We'll get to why they did that in just a minute. It's worth noting that Atlas revenue, MongoDB Atlas revenue, is up 36% year over year and now accounts for 2/3 of total revenue. If we look at some of the key numbers, total customers was up 19%, direct sales 17%. Those are usually larger customers. Those using Atlas, which is pretty much the entirety of the total customers, was up 19%. And then customers with over $100,000 in revenue was up 28%. So all in all, pretty good. It is worth noting that when you see customers up about 19% and yet revenue is up 30%, that's got to mean that those existing customers were paying more over year, and we'll get to that truth in just a second. They said that net ARR expansion rate was over 120%, which means existing customers are using 20% more. That is a great sign. Let's look at margins, all on a non-GAAP basis. Gross margins expanded meaningfully, while operating and net margins more than tripled. That is a very good sign. Free cash flow went from a loss to a gain of $36 million. Same dynamics with net income. Pretty solid balance sheet with about $800 million net cash. Now, if we look at the company's income statement, this includes stock-based compensation, but it still shows the overall dynamics, which is total revenue growing 30%, but the cost of that revenue only growing 14%. That's a great sign. Revenue's growing twice as fast as the cost of revenue is. This is scaling that happens with a cloud-based business. Therefore, gross profit grows even faster at 36%. Even faster than that if you take out stock-based compensation. Same thing happened with operating expenses. It only grew 15% while revenue was up 30%. When that happens, then in this case, it's a loss from operations narrows by 15%. Now, it is worth pointing out that stock-based compensation is still significant, about 27% of revenue, which leads to a 3.9% dilution rate, which should not be ignored. That's not nothing. When the company came out with guidance, there was a lot to like. Revenue guidance for the current quarter is for 19% growth, while Wall Street was just expecting 15%. Also, earnings per share is ahead of Wall Street's guidance. And for the full year, which pretty much just includes the next quarter, MongoDB is calling for 29% growth, while Wall Street was just expecting 25%. More than tripling of earnings per share on a non-GAAP basis. That's better than Wall Street was expecting. So I'm a shareholder myself. What am I going to be watching? First is those $100,000 total customers. As they get more customers, that means that they're winning over workloads, and that's important. Number 2 is Atlas revenue. Number 3 is those operating margins. We're going to look at that both on a non-GAAP and a GAAP basis. And number 4 is free cash flow. There is no doubt that the moat is widening, and the thesis is very much on track for owning this company, which is why it scores so well on both Brian Feroldi's and my checklists. But we've got to turn to valuation now, and for that we head on over to YCharts, a tool that Brian Feroldi and I use every single day. If you would like a free trial of YCharts, click the link in the show notes below, mention Brian Feroldi's name, and you'll get 20% off. So we've got to consider, where in the growth cycle is MongoDB? We know that they're free cash flow positive, even if on a GAAP basis they're over here. So I would say they're somewhere in this range, which means that we can check out things like price to gross profit, forward earnings, and free cash flow. So if we start with gross profit, it's been growing nicely. with a market cap of about $30 billion and about $1.2 billion in gross profit. This is trading for 25 times gross profit. That is an expensive valuation. If we look at its forward PE ratio of about 185, while that's meaningfully less than it has been in the past, that is still extremely expensive. And we don't get much help with the price to free cash flow either, because the free cash flow is so low. The important thing is that this is at the very least in the self-funding area. They don't need to rely on Wall Street to raise money anymore via stock offerings. So the question then becomes, well, how expensive is this stock? Is this worth holding on? Look, it's important to remember that 8 months ago, MongoDB came out with earnings, and I said, this is absolutely wonderful earnings. The stock dove, and it fell to about $194 per share. And I said, if I didn't already own 5% of it, I'd be backing up the truck. That was just 8 months ago. And that has played out well because the company has more than doubled since then, but hasn't gotten ahead of itself. Well, here's how I like to think about that, and I think it's really important. What I like to do is do a reverse discounted cash flow model. Now, this is a tool that Brian Feroldi, Brian Withers, and I have built, and you can get a free copy of it by clicking in the link in the show notes below. But what you have to do is just put the company's ticker symbol in there, put in its free cash flow over the trailing 12 months, in this case, $88 million. That's it. We'll give it a 2% terminal growth rate. 10% discount rate just means it would match the market's returns. And right now, because the market hasn't opened it, this is really trading for about, let's say, $400. So we want this to equal $400. And when we do the math, I mean, oh man, this really has to grow fast. 49% for a decade is what free cash flow has to grow by. So like full stop, and let's talk about that. 49% growth in free cash flow for a full decade. That is some richly valued company. However, it is worth considering this. Right now, MongoDB just has a 5.5 free cash flow margin, which means that only 5.5 cents of every dollar that comes in becomes free cash flow. Will it be that way forever? No, it won't. My best guess is it could reach as much as 30 cents for every dollar becomes free cash flow. And so what that means is if it's at 5% and it could go to 30%, that means that free cash flow could grow 6 times faster than revenue does. And if that's the case, well, then maybe this isn't so ridiculous. So let's head back to this and I'll show you another way of looking at this, okay? So if that were the case, if it had a 30% free cash flow margin, that would give the company roughly $500 million in free cash flow right now. And so whatever this is going to tell us how much revenue needs to grow over the next 10 years because we're assuming that it's optimized. Now, obviously, it's not going to be 49%. That's a crazy high number. What about 30%? Nope, that's still really high. We want this to be about $400. What if we knock it down to 20? Now we're getting closer, maybe 23. So 23%. So what we're saying is MongoDB needs to grow its top line by 23% for a full decade in order to justify today's price. The company is expected to grow its top line by about 25% over the next 2 years. Now, it's worth noting because this is a usage-based product, its growth rates actually can decelerate and accelerate. It's not like a standard subscription-based business where it's kind of like a slow sloping down. Because it's usage-based, it can go up and down. But I'll admit, this is a company that now accounts for about 8 to 9% of my own portfolio. And while I said when it was at $194, it was no way I was going to sell, this is something I'm considering selling now. Now, selling all of it? Absolutely not. This is incredibly anti-fragile business. I am not doing that. But what I might consider is reducing my position to about 5%. So that if a better opportunity comes, I can use that extra cash if I sell soon so that I could buy a little bit more. I know that's a divergence from where I've been in the past, but I've learned lessons the hard way about valuation and applying them. I'm certainly not going to sell out of MongoDB altogether. This is a great company, but it is worth looking at the valuation now. I hope that helped. We'll check back in on this one in 90 days. Until then, Brian, out.